No empire in history has ever collapsed simply because it lacked soldiers. They collapse because they lack a solvent currency. Imagine the year 1945. America emerges from the smoke of World War II as the world's undisputed creditor, even with a debt of 106% of GDP. Back then, we thought that was the absolute ceiling. We were wrong. Today, we are staring at a trajectory toward 156% by the middle of this century. But here's the secret: the mainstream media refuses to mention. This system isn't broken. It is functioning exactly as it was designed. While you sleep, the interest on this mountain of red ink is growing by nearly $2 trillion annually. The monster is no longer at the door. It is in the basement. It is hungry, and it has just started to eat. To understand how we got here, we have to look at the cracks beginning to form in the foundation of the American dream. The structural integrity of any great power rests on its ability to pay its debts without destroying its future. For decades, the United States operated under the assumption that growth would always outpace its borrowing. But the math has changed. Imagine a nation so burdened by its past that its future is being liquidated in real time. We are approaching a moment that was once considered impossible. By the year 2029, federal debt held by the public is projected to reach 107% of the entire U.S. gross domestic product. To put that in perspective, this exceeds the historic peak set in 1946, a time when the nation had just finished financing the most expensive war in human history. Back then, the debt was a temporary necessity of survival. Today, it is a permanent feature of the landscape. We are not in a state of war, yet we are borrowing as if the world were on fire. This is not a political opinion. It is an actuarial certainty. If current laws remain unchanged, the trajectory does not flatten. It accelerates. The Congressional Budget Office projects that within 30 years, public debt will soar to 156% of GDP. We are moving into uncharted waters, where the interest on the money we have already spent becomes the primary driver of our future insolvency. This brings us to the most dangerous mechanism in the federal machine, the interest trap. By the year 2026, the cost of servicing this debt will reach 3.2% of GDP, a level that officially surpasses the previous record set in 1991. This is a massive reallocation of national wealth. In the first 2 months of fiscal year 2026 alone, interest payments were already nearly 12% higher than the previous year. We have reached a bizarre milestone where interest payments have become the second largest expenditure in the federal budget, surpassed only by Social Security. Think about that. The government is now spending more on the rent for past money than it spends on the defense of the nation or the education of its children. Over the next decade, net interest outlays are expected to total nearly $14 trillion. This is capital that will never build a bridge, fund a laboratory, or lower a tax bill. It is money that simply disappears into the ledger of the creditors. But why is the spending so impossible to restrain? The answer lies in the demographic squeeze. It is a slow-motion tidal wave that everyone sees coming, yet no one has the political courage to stop. The American population is aging. As the baby boomer generation enters retirement, the strain on Social Security and Medicare is transforming from a manageable obligation into an existential threat. By 2055, spending on these programs for those aged 65 and older will consume more than half of all federal non-interest spending. We are witnessing a fundamental shift where the state is becoming less of a provider of services and more of a massive insurance company with a standing army. Medicare and Medicaid alone are projected to jump from 5.8% of GDP today to over 8% in the coming decades. While these costs explode, the government has found a way to increase its revenue without ever asking for a vote. It is called real bracket creep, the silent tax that feeds on your progress. As inflation pushes nominal incomes higher, more of your earnings are forced into higher tax brackets, even if your actual purchasing power has remained stagnant or even declined. You feel like you are working harder, but the system ensures that the government takes a larger percentage of your effort, simply to keep its own head above water. This is the largest projected source of revenue growth for the next 30 years, a system that relies on the slow erosion of the value of your work. The compounding effect of these factors creates a crowding out of the American economy. When the government borrows at this scale, it absorbs the capital that would otherwise fund private innovation and business expansion. This leads to slower growth, lower productivity, and stagnant wages. The average worker sees the prices rising and the opportunities shrinking, but the cause remains hidden in the fine print of CBO reports. The risk is no longer just theoretical. High debt levels increase the danger of a sudden fiscal crisis where investor confidence evaporates and interest rates spike without warning. The space for policy maneuvers is shrinking every day. The numbers suggest a bankruptcy, but the reality suggests something much more complex. If you ran a business with a 30-year trajectory of widening deficits and interest payments that consumed your entire profit margin, no bank would touch you. Yet the United States defies the gravity of traditional math. Imagine a world where the more a nation owes, the more the world begs to lend it money. This is the reality of the American dollar, a currency that remains the undisputed center of the financial universe. Despite a national debt that has long since passed the $34 trillion mark, the greenback still accounts for approximately 60% of all global foreign exchange reserves. It is the oxygen of international trade. Most global transactions are still priced and settled in dollars. providing the United States with what economists call an exorbitant privilege. This privilege allows Washington to refinance its massive debt at costs far lower than any other nation on Earth. But why does the world continue to subsidize a borrower that shows no intention of paying it back? The answer lies in the paradox of fear. When a geopolitical crisis erupts in Europe, or a banking tremor shakes Asia, investors do not flee the dollar, they run toward it. In a global neighborhood where every house appears to be catching fire, the American Treasury is perceived as the house with the smallest flame. International demand for U.S. government bonds remains exceptionally high, because in the eyes of the global elite, there is no other market with the same depth, liquidity, and perceived rule of law. This creates a self-reinforcing loop. Global instability drives capital into the U.S., which stabilizes the dollar and allows the government to fund even larger deficits. Every time the United States hits a crisis, the world gives it more money to manage that very crisis. Ask yourself, is this a sign of strength or a lack of alternatives? We are living in an era where the dollar's dominance is being tested by domestic political polarization and a growing erosion of trust in institutional independence. There are increasing challenges to this status quo, particularly as political interventions and expansionary fiscal policies, such as those seen in recent massive spending bills, raise alarms among international creditors. Yet for now, the mechanism holds. The world's central banks are effectively trapped in a symbiotic relationship with the American debt machine. If they stop buying treasuries, the value of their existing holdings collapses. If they continue, they fund the very debt expansion that threatens the system's long-term stability. It is a high-stakes standoff where the United States is the only player allowed to print the chips. This dynamic buys Washington time, but it does not erase the underlying rot. The world is trapped in a room with a monster, and for now the monster is the only one with a flashlight. To survive, the system must maintain the illusion that the flashlight will never run out of batteries. If you were the CEO of a Fortune 500 company, and you walked into a board meeting with a plan to run a 7.3% structural deficit indefinitely, you wouldn't just be fired, you would be escorted from the building by security. In the private sector, a business that spends more than it earns while its interest payments cannibalize its research and development is a dead entity walking. Its shares would be worth zero. But in the halls of Washington, this same mathematical catastrophe is rebranded with the dignified title of macroeconomic policy. We have reached a surreal milestone in human history, where $1 trillion in annual interest payments is treated as just another Tuesday in the Capitol. The irony is as thick as the policy papers that attempt to justify it. We are told that political polarization is the greatest threat to the nation, yet both sides of the aisle seem to find common ground in one specific area: expansionary fiscal policy. Whether it is labeled as infrastructure, social safety nets, or the big beautiful bill, the result is a singular, relentless acceleration of the fire. These massive spending packages are often marketed as solutions to the very economic instability they help create. It is like trying to put out a blaze by dousing it in high-octane fuel and then marveling at the brightness of the flames. While the average 25 to 45-year-old investor watches their purchasing power evaporate, wondering why their hard-earned savings buy less at the grocery store every month, the financial elite are reading a different playbook. They understand the game being played. For Wall Street, the volatility created by a debt-burdened system isn't a bug, it is a feature. High debt leads to market swings, and market swings lead to profit for those who have the tools to hedge against the chaos. They are not waiting for the system to fix itself, they are positioning themselves to profit from its inevitable corrections. This is the normalization of the absurd. We have been conditioned to accept a world where the government's primary role is to manage its own insolvency while maintaining the illusion of stability. We are told the system is secure even as the Congressional Budget Office quietly updates its projections to show a debt load that would crush any other civilization in history. We live in an era where facts are secondary to the narrative, and the narrative says that as long as we keep printing, we keep winning. But patterns are stubborn things. They do not care about political narratives or expansionary bills. They only care about the inevitable laws of mathematics. History shows that even the most resilient patterns eventually meet a breakpoint. Imagine a world where the engine of innovation simply runs out of fuel. It doesn't happen with a bang, but with a slow, agonizing stall. This is the reality of the crowding out effect. When a government consumes trillions in capital to service its past, it leaves nothing but crumbs for the future. Every dollar borrowed to pay interest on old debt is a dollar that will never fund a breakthrough in medicine, a revolutionary startup, or a pay raise for a worker. We are witnessing the systematic depletion of the American dream, where the next generation is being asked to run a race while carrying the weight of their ancestors' excesses. As private investment is pushed aside by federal borrowing, productivity withers, and the vibrant economy we once knew begins to look like a stagnant relic. We are now approaching a critical juncture. The year 2026 is no longer a distant point on a chart. It is a looming fiscal shadow. As net interest payments surge to record highs, the margin for error is evaporating. The danger is not just that the numbers are large, but that the trust holding them together is fragile. A sudden erosion of investor confidence, driven by political instability, or the sheer realization of the math, could trigger a crisis that no amount of money printing can solve. We have seen this pattern before in the ruins of other great powers who believed they were exempt from the laws of arithmetic. This brings us to the core question that will define the next decade of your life. Is the US dollar the foundation that allows this debt to exist? Or is the debt the Achilles heel that will finally bring the dollar down? For 80 years, we have lived in the shade of a massive tree, assuming it would stand forever. But the roots are being eaten by the very system that planted them. History provides the patterns. You must provide the preparation. The year 2055 might feel like a distant abstraction on a bureaucrat's spreadsheet, but the interest payments of 2026 are already at your door. In 1945, when America stared at a mountain of debt, it had a manufacturing heart and a plan to pay it back. Today, the strategy has shifted from production to a dangerous reliance on the printing press, and the hope that the world never stops buying our red ink. We are witnessing the slow-motion erosion of a superpower's foundation, where the safe haven status of the dollar is being traded for one more year of deficit spending. The system isn't rigged because it is failing. It is rigged because it requires your continued participation and silence to keep the debt alive. If you are starting to see the patterns that others are choosing to ignore, the rising interest, the demographic squeeze, and the silent tax of bracket creep, you are no longer just a spectator. You are a witness to the endgame of an era. Leave a 1 in the comments if you believe we have already passed the point of no return. We are financial money history. The next chapter is yours to write.